Welcome to TheoTrade. This is Don Kaufman. July 13th, 2022, minutes after the cash close here on this Wednesday afternoon, does what has amounted to a smoking hot CPI indicate a more aggressive Fed moving forward? Before I even dig into the marketplace, obviously there's a huge amount to talk about inside of some of the trade activity today. But before I even get there, for those of you maybe not aware, and I actually want to start with this on this evening's video, take a look. This is the Cme Fed Watch Tool. Now, some people might be familiar with this. Maybe some of you actually know how to use it. I'm going to walk you through a couple of aspects because some aspects of this are just, well, it's downright shocking how much has actually changed in such a short period of time, all predicated on the idea of what has been, again, it was a really hot CPI. CPI came out at a cool 9.1%. Now, we could probably say maybe CPI has peaked because energy prices have actually come off, but hey, the day is young and oil could still rally back in the next couple of days, right? So with that, let's talk a little bit about the next Fed meeting and why the market has cause for concern. First of all, current target rate. This is what we term Fed Fund futures. So if you're unfamiliar with this, what it really breaks down to, it's about 1.5, okay, to 1.75. Now, what the numbers are down below, you have this 23% and a 76%. Okay, the 23% and the 76%, these are representative probabilities. Probabilities of what? Of the rate increase. What rate increase? How much? Well, if you take this and you say, all right, here's 1.5%, and there's a 23% chance of, 2.25, right? So what would that effectively be? This one over here is a 75 basis point hike. So they're actually presenting to you almost a 24% chance of a 75 basis point hike, right? So I say 75 basis points, but what does it really come down to? It comes down to 3/4 of a point. Now, on the other hand, and probably most shockingly, look at this, 250, 275. It's crazy because that's a full, 100 basis point hike. It's huge by huge. I can't believe that we're even talking about the Fed raising rates by a full 1%. Let's just destroy the economy. Okay, it's and by the way, there's a little refresh tool in here. You can refresh it. And you go, what are these based on? This is based on Fed Fund futures. Like, this is on a live market. This is not Don just saying like, hey, this is what it is. I mean, these probabilities are insane, and that's, again, it's for the coming July 27th meeting. That's the actual announcement day, is July 27th, so we're 2 weeks away from a Fed meeting where now the marketplace is pricing in almost a full point increase. Now, I can't say that I am on the same page. Like, this probability could change a little bit, but I will say this. I'm downright shocked, at the dramatic change in such a short period of time. What to think about it? I mean, when we're talking about the Fed, they're going to raise rates and they're going to raise rates, but then you cruise over here and you look at like TNX. And the interesting thing is, what happened to the interest rates associated with 10-year today? They actually traded down. But let's actually cruise over to Tastyworks, because I think Tastyworks just does a much better job because they have access to small exchange futures. And what's so cool about this, take a look, because everybody gets confused about, interest rates going higher and interest rates going lower. Here's the bottom line. And again, I think that Tastyworks does the best job of delineating exactly this. If you look very carefully right here, and again, these are small exchange products, that's your 2-year. The 2-year now is sitting at 3.137%. Then if you look at the 10-year, the 10-year actually backed off today to 2.916. There we go. And of course, the 30-year also backed off. We're so inverted. And by the way, a moment ago, you were actually looking at a couple of trades that I have on. You know what some of my trades are? This is the 10-year versus the 2-year. I'm long the 2 and short the 10. Yeah, it's gold, Jerry. It's gold. The trade was absolutely huge today. I've been long 2, short 10 for quite some time. looking for a massive yield curve inversion, and a massive yield curve inversion we have. So the assumption of interest rates are going up, duck and cover, but 10 years actually going down, that does not look like a warm and fuzzy sign. It's not just recession, man. We're getting beyond the idea of recession here. We're talking hard landing. We're talking about a more aggressive Fed. To me, it's not about a more aggressive Fed. The Fed at this point, though, with CPI being 9.1%, they're backed into a corner, painted into a corner. Okay, they have no way out of the corner except right through us. And us being everybody. They have to raise rates. Now, I don't care whether they do a 75-point basis hike or 1%. The rhetoric that's going to come out of the Fed is going to be extreme. By the way, I wanted to point this out. Let's actually start to break down the marketplace a little bit here. The S&Ps this morning threw a warning shot at you. And if you didn't read into this, you're missing. Okay, you're missing it. This is the CPI print. We actually traded 38.60. And that's a 1-minute candle, people. We traded all the way down to 37.88. How do you feel about, 60, 70, 80-point moves? In fact, we had a 110-point move inside. If you actually counted a 3-minute window, there's a 110-point move inside of the S&Ps. That is not a healthy move. S&Ps today closed just south of 37.97. One of the most critical aspects of where the S&Ps, though, happen to close, revolves around the SPX, the mother of all products. People, that is the line in the sand right there. For those of you unaware, uninitiated, have no idea what I'm referencing, this, people, is what we actually talk about in terms of expected move. Okay, what does expected move do for us? Well, it actually displays what the option market depicts risk to be. And in this particular case, the expected move, we're holding the line right now. So this does not bode well for the remainder of the week. We're plus or minus approximately $94 this week. We hit the edge of the expected move literally on Tuesday. Here we are on Wednesday. What did we do? We closed literally on the edge of the expected move. Hold the line. The entire trading session today, all we did the entire trading session today is skirt the lower edge of the expected move. The most pivotal number for the remainder of this week, the most pivotal level, is right here. It is 38 roughly 38.05. And the reason is, I don't want you just to write it down, like sear this into your head, the 38.05, because if we start to break a little bit lower and off of it, we're kind of doing that here a bit in the after hours, but if you start to break lower than 38.05, everybody that is anybody is going to have to hedge in the direction of it. And why do I sound so adamant? On a week-to-week basis, I talk about this, but this week, this is completely different. You actually have several options expirations coming off in the SPX. Okay, I mean, there's tens of billions of dollars coming off. And you have a Thursday, obviously Thursday expiration, but you have a Friday morning and a Friday afternoon. Okay, this is an extra special one. I mean, just there, put down, there's only 22,000 open contracts. 22,000 to the 3,800 strike. We have about 30,000 open at the 3,800 strike on the put side of it. Do you have any idea what that kind of open interest, how much gamma risk is going to be created? That doesn't mean, by the way, this doesn't mean that we're going to sit at 3,800. On the contrary, it means that if we start to hedge or go lower, everybody has to hedge in the direction of the marketplace because there is an inordinate amount of risk due to the primary expiration that is a monthly AM expiration and a PM expiration. Oh, it's double the fun. Look how much open interest is here. It is dangerous out there. Okay. The other aspect is if you look between now and the Friday expiration, that's almost a 70-point move. How come you can have a $94 move for the entire week, but all of a sudden there's only Thursday and Friday left, and now you have almost a $70 move? Go figure, right? Okay. This is serious implications here of risk. All right. That is one of the most critical aspects, along with, the whole Fed rhetoric. Listen, it's just going to be Fed speak. And we already had some Fed speak today, and that actually caused a little bit more of some sell side activity. But the Fed is actually going to be in a quiet period very soon before their meeting, which is going to leave every single announcement that comes out that has anything to do with the economy is going to have the entire marketplace on pins and needles. This marketplace is a powder keg, okay, of risk. And one of the other issues is, we can talk about volume all day long. Look, the S&Ps, they did 2 million, contracts today. That ain't bad. Yeah, I know. But some of the volume, if you look at active trader, you look at the bid size and the offer size. Listen, you can't discern anything about direction from the bid and offer size. What you can discern, though, these are some of the most thinly traded markets I've ever seen. That is, not even the market making firms are stepping up to make deep markets, which is going to make the S&Ps move, jump, skittish as can be. Again, I can't reiterate enough, the trade for the remainder of this week, downright dangerous. We need to hold 38.05. Or we're going to break substantially lower. Speaking of substantially lower, ironically, tech held it together. Financials actually led us slightly lower. Speaking of financials, guess what? You have JP Morgan coming out in the morning. Oh, yay, Jamie Dimon, along with Morgan Stanley. So earnings are officially, okay, in full swing starting tomorrow. Okay. The other aspect worth noting here is that, all right, so the S&Ps were down 27. The financials were down just shy of about 1%. What really dragged us down was the financials. Again, tech is kind of scattered and broken at this particular point. Nevertheless, as interest rates actually decreased in the long run of the curve, the tech sector seemed to kind of mellow out a little bit. People, right now, there's a whole lot of confusion and a whole lot of risk. This does not make for a good combination. Last but not least, looking at volatility, we still have significant issues here. VVIX incredibly low, even though the skew is likely to have picked up today, and we're still looking at a skew down to 121. Volatility futures, even in the height, okay, of fear and loathing in this market today, the volatility futures, they never really took off. Okay, again, there's not a lot of factors to this marketplace to love right now. You know, you talk about risk reward, and I'm always looking at risk reward. Is there upside potential? Of course. The downside risk, once again, is phenomenal. I'm going to say that again. The downside risk for the remainder of this week is phenomenally large. Okay, too many factors on the screen right now that are negative. Frankly, I think that the fact that the S&Ps are only down 0.7%, we squeaked by today without taking any significant loss. Pretty much by the skin of our teeth. Again, the S&Ps could face some significant risk. Again, do not discount the ability for the marketplace to stage some type of a rally. Okay, the rally is likely very, very short-lived, and the rally is going to be mitigated to the upside versus, again, a significant downside risk. That's it for this evening. Again, July 13th, 2022. Thanks, everybody. Have a wonderful evening. Bye-bye.